Okay, Luke, I see you. I'm going to make you a panelist because I'm not sure you're bringing charts with you. If so, then I'll make you a presenter, but at least we'll be able to hear you. And I'm showing your website right here. So nice to meet you, Luke.
Nice to be here. Thank you very much for having me on, Dale. I appreciate it.
Oh, it's great to have you. Did you bring anything you wanted to show? Because I'm showing your website right now.
Yep, I'm seeing that up there. You know, when you said interview, I just thought you'd, if you had questions, I'd be happy to answer them. I can,
Yeah, that's perfect. We can do audio, and I've taken a look at your website here. I love the name for the trees, because so many times traders get caught up in the minutia and the short-term views and trade off 15-minute, 1-hour charts, etc. I'm interested in how you got involved in the industry and what the beginning of your journey was like at point A, and I'd consider where you're at now, point B. So can you tell us a little bit about your background?
Absolutely. So I've been, I started out in the business, almost 23 years ago, way back in 1995, in the research business. There was a old line Cleveland money management firm named Ralston and Company that had a small sell side operation, and so I started off in research there, and then was part of a very small group of people that formed Midwest Research in 1996, which was really a pioneer in doing survey work, channel checks, background, sort of real deep in the weeds, bottom-up fundamental research. We grew that business from 1996 through 2001, was made a partner there, and we sold that business to First Tennessee Bank in early 2001, and was renamed FTN Midwest, and grew that business further. And sometime around 1997 or 98, I made the jump over from research into equity sales, and was calling on a number of institutional accounts for the firm. 2001 to 2006 was at FTN Midwest, and in the late 90s, while still at Midwest before we sold the business, I was one of the creators and the editor of a weekly product we would put together, where I would aggregate a bunch of the firm's research and then also marry it with different macroeconomic and thematic things I was reading on my own time, and we called it The Herd in the Midwest. And it came out every Friday, and it quickly became a very widely read, very popular product with our customers. Continued that after FTN bought us in 01. And then in mid-06, myself and 20 other partners left over a weekend to form Cleveland Research Company. And again, I was wearing a sales hat there, and I had reprised my role as the creator and editor of a weekly product for our customers that was, again, putting pieces together, very widely read and by our customers, and was always complimented for my ability to put what seemingly disparate pieces together and figure out things or trends that might be occurring. That was something that helped the customers, the accounts I was calling on for the firm tremendously in 07 and in 08. I was able to help advise customers to position well for what transpired then. Post 08, as the world became more central bank and macro driven, I was spending more and more of my time on those topics, and by 2013, approached my partners about focusing on some sort of macro or thematic product full time, and they said, yeah, we'd love to have you do that. My one caveat was that I wanted to have complete creative control to write whatever I wanted to write whenever I wanted to write it. And from a marketing standpoint, as a firm, Cleveland Research was still very well known for its very in-depth in the weeds, bottoms up research, channel checks, etc. And it just kind of had a hard time figuring out where they would place such a product in terms of their, in terms of a marketing standpoint. And so instead, we agreed to part ways amicably in late 2013. In early 2014, I hung out my own shingle as FFTT, Forest for the Trees. And what I do is I aggregate a large amount of disparate, publicly available data points in a unique manner in an attempt to identify developing economic bottlenecks for our customers who are institutions and high net worth individuals.
Okay.
And,
so you answered my next question. So originally directed towards institutions or people with a net worth of what, over what, to be able to.
It's not an accredited product, so so it really is. It tends to. Our subscription prices tend to tend to be more geared towards people with some level of net worth to trade to invest.
What is your do you have what's your monthly or yearly subscription rate? May as well get it out there.
So it is it is $5,000 a year for an individual read only, and then it's $10,000 a year for full touch, full subscription. We publish a report, every Thursday that's 8 to 10, 12 pages, and then also we do a pre-recorded webinar every other Tuesday, and then we also have sort of flash reports we put out when something grabs us that is important, we think, milestone, and something we've been talking about prior.
Okay, well, I'm familiar with Raul Paul. I've interviewed Raul a few times. He's one of the creators of Real Vision that you did an interview on, and I'm looking at your media appearance here that you did a interview with them, and what really sticks out to me is how you really focus on global FX reserves as being significant and the linchpin to that every other asset class spins around. Am I reading you correctly as far as your thesis on currency is really the largest market and has the largest impact on everything else, even bigger than bond markets?
Yeah, I think, we've really been focused on these FX reserve markets, the global FX reserves number, simply because it was such a big change, and it was very underfollowed, underappreciated by the street, right? So for 70 years after World War II, up until the third quarter of 2014, throughout all the various crises and emerging markets, et cetera, that had been a one-way data item. Sometimes it grew faster, sometimes it grew slower. It grew very fast post '02, but for 70 years, FX reserves rose, full stop. And then in 3Q14, over the next 18 to 24 months, they fell roughly a little over $1 trillion, peak to trough. They've kind of stabilized where they are, but it was.
Why? Do you know why they fell while central banks were on a printing mission? Why they fell? Was it velocity, or it was the stock of money?
That is in a way a $64,000 question. The mainstream narrative is that they fell because oil prices began falling in late 14. And it was just sort of a traditional emerging market, commodity-driven crisis, right? Where oil prices fall, and so the amount of petrodollars in the system fall, and then these nations need to start burning down FX reserves in order to sort of preserve their currency valuations, and that I think there is an element of truth to that. The thing that I think is underappreciated is that remember, 3Q14, FX reserves peaked and began falling. Number one, in November of 2013, the PBOC came out and said it's no longer in our interest to stockpile FX reserves. So China, as much as the mainstream narrative of the decline in FX reserves, and and China was a part of this, was this was all defense. This was emerging markets being choked off by the strong dollar. It's very odd that China would announce, 9 months before they peaked and began falling that, basically, hey, we're done here. The second thing that is a bit of a fly in the ointment for the mainstream narrative is if you go back to 3Q14 also, you began seeing, and in theory, these FX reserves would be being sold down to relieve dollar shortages experienced as oil prices fell. The weird thing this time that it, again, had never happened before in at least 70 years and under the current system was that if you go back to late September 2014, in a very short span of time, you had Russia, you had Ecuador, you had Venezuela, all come out and say we're experiencing dollar shortages, which is curious because at that time, oil was still priced at between $95 and $100 per barrel. And so you've got these oil exporters who are all running current account surpluses. In other words,
right.
In theory, they're only, they're selling, or they're selling more than they're buying.
Yeah,
so they should have net dollars inflowing. Exactly.
They should be very liquid with dollars.
Exactly, and they weren't. They were having shortages. And to us, the missing, at the time we wrote to our customers and said, A, number one, this is really bullish for the dollar. But number two, what's creating this? It shouldn't happen unless, A, these countries got wildly more corrupt over the last 3 months. In other words, basically the excess liquidity was being drained off at a massive rate by the politicians or domestic sector. Or alternatively, they're beginning to sell oil or settle oil in non-dollars. And interestingly, if you look back to 2Q14, there was this holy grail, what was called the holy grail energy deal or gas deal between Russia and China. And it was rumored that that deal was done in non-dollars. And so if you start, it was later confirmed that it was done in non-dollars. In August of 2014, Putin came out and said the dollar's monopoly in global energy trade is damaging the economy. We're going to move away from the dollar. And so long-winded way of saying, the reason FX reserve, we think the accepted mainstream narrative reason for the decline in FX reserves, the first such decline in 70 years, and the actual reason may be very different. And in the near term, it's sort of semantics because the outcome is the same. It's a deflationary environment, the dollar should strengthen. But the further away you get from 3Q14, and of course we're now into year 4 away from that, the real reason becomes less semantics and more important to focus on. And what we ultimately think, and what we think the preponderance of the evidence shows, is that it was because the world began to de-dollarize the global oil trade. And
so a main part of your thesis, this began to show up a few years ago, and now that, and this may be 2.0 of this, with China going to an oil exchange priced in yuans, convertible to gold, I believe. Is this the next step in de-dollarization from the petrodollar and the reserve currency?
Yeah, it's the short answer is yes. I mean, to be clear, it is what we think China is doing, because there's been a whole bunch of speculation on that this is a gold-backed oil contract. It is not. Okay. But if you look at what China is doing, it appears that they are merely reopening the Bretton Woods gold window at a floating gold price through yuan, or if you're really an economic history buff, effectively what they appear to be doing with gold is establishing an alternative economic currency system, effectively, using gold as the bancor that John Maynard Keynes proposed at Bretton Woods, where, if you recall, he had his proposal was not where the world ultimately went, but his proposal was you have all currencies float against the bancor, and the bancor is a neutral floating reserve asset that would float in each currency and sort of settle imbalances before imbalances got too big. And the reality was the U.S. had all the men's and all the guns and all the gold and all the oil, and so we just said, no, this is how it's going to go down. And we got the Bretton Woods gold standard. So, but what we think China's doing with gold is all about oil. Ultimately, we think it's a matter of national security for China to be able to gain the ability to print yuan for oil. To do that, there's two issues. Number one, few, if any, people trust the yuan more than the dollar, but just about everybody will trust gold more than the dollar. And so opening the gold window to allow settlement of offshore yuan imbalances created through the energy trade suddenly sounds like a really good deal if you are, Russia or OPEC, et cetera. The second point is that, if you settle imbalances in your currency, in your sovereign debt, you end up basically jumping feet first into Triffids Dilemma, which we've seen here in the U.S., which is that if you settle your offshore balances in your sovereign debt, in the short run, you get, a short and medium run, you get a debt-fueled consumer and government spending party. And in the long run, what you get is the bankruptcy of your country. But doing this forces you over time to have to offshore your production. You've got to send your jobs, your manufacturing jobs elsewhere. You have to run deficits. And that's why in the long run it bankrupts your country. And that's, I think, the other reason China is looking to gold, or why they've talked about SDRs or neutral assets really since immediately after the crisis back in 2009, is because they understand this. They don't want to send all those factories that have gone there somewhere else so that they can run the deficits needed to supply the yuan and yuan denominated, yuan sovereign debt or Chinese sovereign debt to settle yuan imbalances in the same fashion the U.S. has. So the goal is really about, A, getting trust, and B, playing the long game in terms of, look, we're not gonna bankrupt our country in the long run to gain the ability to print yuan for oil in the short run.
Okay, so sometimes markets that are going through a transition do so in a glacial manner. And you started noticing this in 2013, 2014. Here we are a month away from 2018. Do you see this beginning to accelerate that could create some type of tipping point? I know you talk about you're looking for the biggest mean reversion in 70 years. What do you mean by this mean reversion?
Yeah, so to me, if you look at what these big gears are doing, what China's trying to do to gain the ability to print yuan for oil, becoming only the second nation to do so. When you look at what that has meant or has begun driving in terms of FX reserves growth, it's really twofold. It's number one, for the first time in 70 years, deficits are beginning to matter to the United States again, and nobody's paying attention to it. Famously, Dick Cheney, Vice President Dick Cheney, reportedly said in 2004, "Hey, look, Reagan proved that deficits don't matter," and he is absolutely right. For as long as global FX reserves go up and up and up ad infinitum, because effectively what that is, that effectively sterilizes U.S. dollar, U.S. deficit outflows. Right. So. But the moment that stops, all of a sudden you start having, sort of the crowd, the legendary or the mythical crowding out effect of government spending that has never happened in the U.S. begins to happen, and we've seen symptoms of that, right? So you've seen the U.S. have to take steps that typically only emerging markets have to take. So in 3Q14. The United States, or the Fed, introduced high-quality liquid asset regulations that effectively forced U.S. commercial banks to have to begin buying a lot more treasuries for capital requirements. That's a classic emerging market strategy. You begin forcing your domestic banking sector to fund the government through enticement of regulations, et cetera. You had money market fund reforms where guess what they had to buy? Again, enticed by regulations. U.S. Treasuries. They have to go out and seek different demand sources that they never had to. That's exactly right. And again, because it's the USA on the masthead of what we're describing. Nobody's looking at what's been happening through an emerging market lens, looking at the U.S. And what's happening through an emerging market lens. But if you do so, a lot of what we've seen since 2013, 2014 starts to make sense, and it helps give you some direction about sort of the potential outcomes. I mean, Another thing that emerging markets in a balance of payments, pressure or problem have is the strategy is they start forcing some of their biggest expenditures onto the citizenry. And what's one of the U.S. government's biggest expenditures? It's healthcare. What did we get in 2013? We got the ramp up of Obamacare, where all of a sudden I know, for example, my healthcare premiums since 2014 have gone from $400 to $1,100 a month. And that says nothing about, there's been no change in healthcare status. I'm a young guy with a young family. He's relatively young. And that says nothing about copays. So you see the U.S. government, force banks to buy more treasuries. They force money markets to buy more treasuries. They force more healthcare costs onto people. All of this serves to crowd out, as you would see in an emerging market.
Why don't they force corporations instead doing stock buybacks to give the U.S. a hand? I guess with the new tax bill that may or may not pass, watered down, whatever, it doesn't look like this is going to do anything to remedy it. It may even exacerbate what you're talking about, don't you think?
Well, I guess it depends what happens to that cash. If they do this and it repatriates a bunch of offshore cash, we'll get what, we would in theory get what we've seen over the last, several years, the last, 9 or 10 months notwithstanding in the dollar, but you'll start to squeeze, you'll further squeeze offshore dollar liquidity, right, which should drive the dollar higher. But if those dollars come back here, they're going to get put in a bank. And if they get, to the extent they get put in a bank, what's the bank going to buy with them? They're going to buy treasuries. They get put in a money market fund, they're going to buy treasuries. So, I mean, again, if you sort of once removed, you can make a case that at least on some level, this is helping, this type of tax reform for corporations would help.
So maybe that's the motive behind it, is to create another demand source for our paper.
I think it's, I would strongly suspect that that's at least a consideration, if not a primary consideration.
So what are the implications that you're looking for, Luke, as we start to wind down a little bit here? We have parabolic moves in global bourses. We have 10-year creeping higher, but really not making much headway towards higher rates. What do you think is going to be a trigger? I actually noticed a tweet the other day that part of the new sanction regime with North Korea was that we were going to take any banks that do business with them out of the dollar system. And there was a tweet about a Chinese bank that may be sanctioned for doing this. I know that China and Russia already have an alternative to the SWIFT system. So could it be something geopolitical that lights the fuse on this, and the mean reversion? I suspect you're talking about asset prices begin to deflate based upon that.
The short answer is yeah. I think it could be a geopolitical, absolutely could be a catalyst. You certainly saw geopolitical catalysts to currency changeover. When we got the petrodollar system, you had some a number of different geopolitical catalysts in the early 70s.
Wars and a depression.
Yeah, exactly. And so, yeah, but I to me, the mean reversion is, the U.S. is starting to have to play by the same balance of payments rules that every other nation on the planet has always had to play by for basically all of history. I mean, if you look back, if you look back, for basically all of recorded history up until 1971, the nation that had the best terms of trade, the most surpluses and the biggest reserves had the best currency, and that's thousands of years. And then for the last 46 years, the nation with the worst balance of trade and the lowest pile of reserves had the best currency. And so everyone thinks the last 46 years have been normal, and the reality is the mean reversion is I think if once FX reserves stop rising, that begins putting pressure on the world to start moving back towards a balance of payments centric system. And then if you look at global currencies,
that dollar bearish?
Oh, horribly.
Okay.
The dollar's not priced in the right zip code if we actually go back to a system that's more based on balance of payments and less on balance of payments and reserve, and less on the dollar as global reserve currency.
Okay.
yeah, you'd rank them by, you know, in theory, you would see the dollar fall against the yuan, dollar against the euro, dollar against the yen, dollar, you know, against the pound. It depends on you know, how they manage Brexit, how they, you know, geopolitically tie with their fortunes with, you know, China, etc.
Does this also mean higher taxes, even though we're being promised with the right hand lower taxes and with the left hand sunsetting those advantages, and also cuts in social programs?
I think that's where it has to go. I mean, I think, you know, it's an unenviable position to be a politician in Washington these days, because you're sort of here, you know, at the tail end of the party, and sort of nothing good can happen because, you know, again, what we're talking about here is when FX reserves are falling, the U.S. government is being defunded. And so, yeah, I think we'll get more things like, you know, Operation Iraqi Freedom, which, you know, that's what it was called. I'm not sure that, you know, that was aptly named. I think we'll get more things like the Affordable Care Act, which did make healthcare more affordable, but it made it more affordable for the government, not for us.
You think there'll be wars? Previously, there's been wars for hegemony when Saddam wanted to be paid in euros, et cetera, et cetera. Although China would be a much bigger adversary than anything we've ever faced before to defend hegemony.
I think, yeah, historically, right, if you read, you know, Graham Allison's and others' work of you know, Graham Allison, I've not read the whole book, I've read a number of articles of, you know, Thucydides' trap, that, yeah, historically, these types of currency transitions or hegemon transitions have resulted in that. You know, the thing about that is it's, you know, that would only accelerate things, like because, you know, the reality is due to the dollar-centric system, America has not paid for its own wars since World War II. And, you know, they've been funded, you know, by the Europeans in the case of Vietnam, and then, you know, the global war on terror was in no small part funded by China. You go to war with China and Russia aren't going to fund that war. And so if we have to fund our own war,
we're broke.
Oh my gosh, it would be so dollar bearish. Inflation rates would explode. You'd have to ration, you know, gasoline. You know, I remember going through my father-in-law when he passed. His mom had, you know, ration coupons for gas and for rubber and for food. And you know, now you're talking about a country who has basically moved away from cities that actually have non public transportation, and moved to regions and cities that basically can't function without a steady supply of cheap gas.
So I'm going to ask you this. You have this belief, and, you know, I wish I didn't know some of these things, Luke. You ever feel that way, that sometimes ignorance is bliss? So yes. I'm assuming you're still in the Midwest, in the Cleveland area. Correct. I'm from Chicago.
Okay.
What are you doing for your own wealth preservation? I'm not going to ask you what you're telling clients to do, but what are you doing, and do you plan to ride out this transition in the Midwest in the USA?
The short answer is yes, I do, but I'm watching closely and I don't know what I'm watching for per se, but I think I'll know it when I see it.
Yeah, how about like going to an ATM and it doesn't work? Would that be a market tell?
That would start to be. That would start to be for sure. You know, look,
so are you an accumulator of physical gold? I'm not going to ask you for your address. How are you hedging yourself for what your beliefs for economic conditions down the road?
Like, I think I am positioning myself in sort of, you know, somebody who reached out to me and highlighted, hey, have you ever seen or read about Jacob Fuger from, you know, I guess, gosh, 300-400 years ago, and just his sort of allocation, which was, you know, call it a quarter cash, a quarter gold, a quarter, you know, equity, you know, equities, and a quarter, you know, productive real estate. And it was an allocation that made its way through all kinds of tumultuous times and progress and distress. And it's actually, you know, the person pointed out to me that it influenced this person said it influenced Ray Dalio's thinking in the all-weather, his all-weather portfolio. But to me, because the timing is uncertain, to me, that's how I sort of have thought about my own portfolio. Maybe the gold is a little smaller, maybe the equities are a little higher. But I ultimately think, when you look at what we're seeing in markets, what I'm seeing develop, if you use this, okay, the U.S. is moving more towards, deficits matter for the first time in a long time. It makes sense that we're seeing these parabolic moves in global risk markets, because ultimately, if I described what I described, if we use this emerging market lens, and we were talking about Argentina, if you're a trader, if you're an investor, what you do, the path is very straightforward. You get your money out of Argentine pesos and you move to dollars. The challenge is that we're talking about the dollar, and so if you got to get away from the dollar, where do you go? There's no other market big enough to take. You don't go into treasuries. That's just out of the frying pan into the fire. So where do you go for safety? And I think
maybe that's what's behind crypto.
I think it's behind crypto. I think there is some element of crypto that's we have the black market Venezuelan bolivar rate. I think there's some element of what Bitcoin's doing that is a black market dollar rate, because there are no derivative markets attached to that, like there is with gold, that change the pricing mechanism. That's a pure supply demand. Not saying it's not frothy per se at any given moment, but I think there's an element of that. But in terms of really big money, you can't go into Bitcoin, you can't go into gold. So where do you go to get out of dollars? You can't go into Swedish kroner. So I think you go into big cap U.S. equities. I think that's what you do, because now at least you're hedged against the dollar, and you're still collecting a coupon. And I think that if you look back to fall of last year, right after Donald Trump got elected, the S&P 500 over the TLT, if you go on a really long-range chart, 25-year chart, it was a clear breakout, an explosive breakout. And to me, I think that was the first sign of, oh my God, this populism is real. This is not just something happening over there. It's happening here. We're going to have to print all $100 trillion we owe everybody. I got to get out of, because remember, we had a big bond sell-off right then too, right? That's brought under control since. But
still trying to recover from that, and we haven't. But so it ends up where a lot of gloom and doomsters say stocks are going to have trouble. It ended up being the best hedge out there.
I think that's what we're seeing, and I think we're going to continue to see that, in no small part because look, if the policies of the U.S. government over the last 25 years have made it such that the U.S. government and the U.S. consumer is intensely dependent on asset price inflation for consumer spending growth, and of course, consumer spending is 2/3 of the U.S. economy, and through that link, both through that link and directly via capital gains and options and IRA withdrawals. Alan Greenspan said in 2015, if stocks have become a large part of a surprisingly large part of U.S. federal tax receipts, if stocks just stop going up, let alone fall, the U.S. government will quickly have a fiscal problem. And so it is, they've set up the system where the stock market's become fundamental.
Luke, it's really been enlightening talking to you, and great insight into that. Eventually the U.S. and we're moving in that direction. The free lunch is disappearing, and paying the piper is what's next. And thank you for bringing this awareness to our community. And I wish you all the success in the world with FFTT. And really glad I reached out to you on Twitter, and glad to call you my trading warrior brother going forward.
Thank you very much for having me on. I really enjoyed talking with you, and it was a real pleasure. I look forward to staying in touch going forward.
Okay, let's get back together down the road and see what's happening with reserves, especially after the Chinese oil exchange opens. That should be great. Okay, thank you so much, Luke. Merry Christmas, Happy New Year to you and yours.
Thank you, Dale. Merry Christmas to you too, and Happy New Year as well.
Thank you, buddy.
All right, take care.
That's it, F.A.C.E. See everyone tomorrow. Remember, don't just count your pips, count your blessings. I hope everyone enjoyed Luke. Great analysis today by Blake, doing some mentoring, and Steve, and we'll see you tomorrow. You're very welcome, Kareem. Adios, my trading warrior brothers and sisters. See you, Madrid. See you, Richard. See you, Val. Thanks again, Luke.